Good morning, everybody, and a warm welcome to today's reverse mortgage webinar. I'm Cindy Bishop with Cindy Bishop Worldwide. It's a pleasure to introduce our esteemed master instructor for today, Kelly Catalinas. Kelly is a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production and cultivating lead generation. And I have to add this, we're especially excited to have Kelly still because her husband has retired and really wants her to retire. So every day we have her, we are 1 day extra on in the lucky department. Okay. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by Washingtonian Magazine, in addition to what she just said today for 2025. Additionally, she has received the 5-star professional award for the 4th straight year, which was bestowed upon 3 out of 3,600 individuals in the Washington, D.C. area in 2024. These are just a few guys of the many accolades that Kelly gets. What really sets Kelly apart is the trust and admiration she's earned from her clients and agents, with I guess probably most of your business's referrals. I mean, it is at this point. Yeah. Today, Kelly's going to share her expertise on the reverse mortgage, which I am just so glad that she got into this because it really opened my eyes. So without further ado, please join me in extending a warm welcome to Kelly. And remember, unmute. Ask that question right when everybody has the same thought in their heads. We really appreciate it. If not, throw it in the chat and I'll be keeping an eye on it, but still it's delayed. So take it away.
My pleasure. Thank you. Appreciate the warm welcome, everybody. Thank you so much. I love a small group, especially with this topic. And we're going to go over what we're going to cover today. And I'll interject some examples in there that might bring it home as we go through. We're going to introduce the topic of reverse mortgages, which affectionately we call the retirement mortgage. Loan qualifications, how you can use it. There are several ways it can be distributed. What happens at loan maturity and why Fairway. So let's just jump right in here. So this is always a question when we talk to people about reverse mortgages and we say, what is your opinion of a reverse mortgage? And it's really 50-50. We get, they're great because people have taken time to learn a little bit more about them. And then we've had the other answer, which is for people that remember a long time ago when there were issues with reverse mortgages and lack of protections. I've heard some bad things about them, but I'm here to learn more. Okay, so keep an open mind as you go through. I can only tell you from the moment that the program was introduced to now, it has undergone unbelievable change with wonderful protections for the consumer. And the one we are going to focus on today will be the FHA HECM. It's a home equity conversion mortgage. We're going to define that. But the reason we are doing that is about 95% of all reverse mortgages in the country are done on this program because it has the most protections. So we'll go through screen by screen. Why wouldn't you get it? So Wade Pfau is a PhD. He's done a lot of research on the benefits in financial planning of using a reverse mortgage. And his point in a lot of his publications are if you use it strategically, you can dramatically improve the sustainability of your nest egg, your retirement earnings, right? The number one fear of people retiring is the unknown, right? Will I have enough, right? And that worry, do I have enough for retirement? Do I have concerns about increased costs as I retire or long-term disability or whatever? So again, we're going to focus on several uses of this and how it may come to help in retirement. Are you 62 or older and concerned about market volatility and inflation with respect to your nest egg? Outliving your savings is the number one reason people ask about reverse mortgages. Okay. Making monthly mortgage payments when you're no longer working and you're living off of your retirement earnings, and not being able to continue to live in your home in a safe, sustainable way. right? You don't want to leave your home, but you're aging, and perhaps your home is aging at the same time. And will that same home accommodate any changes in your health or needs as you age in place? Okay. So again, what is a reverse mortgage loan? Okay. It is exclusively for older adults age 62 or older. It converts a small percentage of your home equity into tax-free cash. There's no required monthly principal and interest payments on this loan, but you will continue to make your taxes and insurance payments. This loan does not contain escrow. So if you're used to having everything all in one payment to your mortgage company right now, that won't be the case. You'll be handling your taxes and insurance on your own when undertaking a reverse mortgage. The home equity conversion mortgage is the most used reverse mortgage in the United States. It initially rolled out back in 1989, but it has, like I said, been rinsed and repeated many times with amendments added and protections for the consumer. And one specific feature, which is the best protection, is something called a non-recourse feature, and I'll define that as we go along. It is insured by FHA, the Federal Housing Administration, and again, you have to be 62 or older to apply for this loan. So we always get this question, well, isn't a reverse mortgage just kind of like the last ditch effort to help people stay in their home? And a lot of people look at it that way, but that is not what this loan can be used for and should be looked at as, okay? People are living longer. You have a lot more um, uh, 62 and older that in better health, perhaps, than a generation before us were at the same age. And so the longevity and actuarial tables are increasing, right? Medications, et cetera, are increasing life expectancy. So there's a lot of wide appeal about using this as a financial tool and thinking of your home as something more than just a home. Okay. You can use it to address an urgent need. You own your house free and clear. Now you need a nurse coming in, you need in-home care. Maybe you want to use it just for lifestyle enhancement. Maybe you have enough in your retirement funds for your monthly bills that you have, but you want to draw down on your reverse mortgage to take a trip every year. And you want to just use it for that one specific thing. You can use it for things not in the budget, like I said, like travel. It can help you with your financial planning and timing of when you withdraw assets from retirement account versus possibly using the reverse mortgage. And again, when used strategically, you can maximize your monthly cash flow and possibly reduce income taxes and minimize risk. So again, I am not a financial planner or a tax attorney or, tax accountant. Okay. So you definitely want to get tax advice, but distributions from a reverse mortgage are not taxed because it is your loan. Okay. It's paying you out of the equity of your home. So it is not treated as income you receive monthly if you take that income monthly. Okay. Just so that's where you're saying you can use it to live on and not pull from retirement funds, which could be taxable. So it could really extend those retirement accounts by letting them stay in place. So pros and cons of a reverse, it's an added source of cash flow. There's no monthly principal and interest payments. You still have to pay property taxes and insurance, and it's a non-recourse loan. And we're going to define non-recourse, but in a nutshell, what it means is the house will always satisfy the reverse mortgage loan regardless of the value of the home. So non-recourse means if you owe more on your loan, you owe this much here, and your house is worth this much, you can give the house back and it will satisfy the loan even if there's a gap, and your heirs would not be responsible for that gap. Okay. So it's a huge feature of the FHA insurance that you're paying on this loan to cover that, you know, if that happens. The cons to it is its minimum age requirement is 62. Actually, it's like within 6 months of turning 62. So if you are 4 months away from becoming 62, you could still apply for a reverse mortgage. Interest and fees on this loan chip away at the home equity. Think of how your credit card works if you don't make a payment each month or you just pay the minimum, right? It's going to grow next month and it's going to grow the month after. That's exactly how this works. You're going to owe more. If if you don't make payments on it, you're going to owe more. What you're balancing is that the equity in your home is going to increase at statistically higher appreciation than what you're going to owe. And it's got to be your primary residence. This is not available for second homes. It is not available for investment properties. It is a primary residence only. Okay, and we're going to talk about the myths, right? The
So
bank,
I got a question, Kelly.
yeah,
So do they determine how much the house is valued at that point in time when you first put applicant in?
yes, you're doing an FHA appraisal.
Okay.
Yep. So, mortgage myths debunked. The bank will own my home. Absolutely not. You are in title on your home, just like you are now. Okay. It's a lien recorded against the property, no different than the mortgage you have recorded against your property now. If you have a revocable living trust and you hold your property in a trust, you can still do a reverse mortgage with a revocable trust in how you hold it. Okay, we just have to have the trust reviewed. It cannot be irrevocable. It has to be revocable, but you can do it in the name of the trust. Your heirs will be stuck with a big bill. Absolutely not. You or your heirs will never owe more than the value of the home after the loan matures and the home is sold. So again, your house is worth 400,000. The reverse mortgage at the time a maturity event happens is 450. You could sign the house away, walk away from it, and you and your heirs would never owe that $50,000 gap. Okay. You have to own your home free and clear to qualify for a reverse mortgage. No, but you need significant equity in the home to do a reverse mortgage. Okay. Typically, you need about 60% equity right now. Okay, the balance is on when interest rates are higher, the amount you can access is lower. So right now, I would tell you if you were at the 62 age area, and we'll get into some charts, you're going to need at least about 60% equity in the property for it to work. So we'll go through the loan qualification. So again, who qualifies age 62 or older has to be the homeowner. Again, own the property outright or have significant equity, like we talked about, primary residence. You've got to meet minimum credit and income requirements. By minimum credit and income requirements, we're looking at credit reports to be sure we don't have any lates on current mortgage payments over the course of the last 12 to 24 months, and no more than 1 times 30 days late on any credit cards over the last 24 months. Okay. So we are looking at credit to look at not necessarily score, but specific repay history currently. Okay. For minimum income requirements, we're trying to come up, if you think about doing a VA loan and in the old days doing FHA loans, we had to qualify people not only on ratio, but on something called residual income, where we would take what are the income sources that they have right now, and what are the monthly debts that come out of that income source. Property taxes, homeowners insurance, car payments, credit cards, condo dues, HOA dues, whatever. And we start deducting, and we have to arrive at an amount for a particular family size for that geographic location in the country, right? So that's what we're doing here. We have to meet residual income requirements that, we have enough income to cover minimum family subsistence. And that's based on family size and charts that we use when we go through the qualification. But it's not a scenario where um, it's not a scenario where um, it's a fully documented loan file. It might only be income information that we request from you, because the reverse would take care of the assets. The assets are only important if we are deriving income from those assets and qualifying you in like anticipated income stream from the assets. Okay, but if we had enough income, let's say from Social Security and pensions, we wouldn't get into bank statements or asset statements if they're not needed. So the eligible property types, again, single families, 2 to 4 unit properties, as long as you occupy one of the units, townhomes, condos that are FHA approved. If they're not FHA approved condos, sometimes we here at Fairway can approve it for a single unit approval. We have an entire condo department dedicated to this process. So it is possible, if it's a project that's not FHA approved, that we might be able to get a single unit approval done. PUDs or townhomes, modular homes, and manufactured homes that meet FHA requirements would also be eligible. So it tells you how much equity do I need, and we're going to go through some examples. And this will say roughly 50%. That depends on age and interest rate availability. I would tell you, given where the interest rates are in the sixes right now, 60% is more likely in terms of equity needed for the reverse. So the amount of money you get depends on the age of the youngest borrower or the non-borrowing spouse. Okay. Sometimes we have a borrower at 62, but the spouse is 59, and it may limit how much we can get out of the property as a result. The interest rate impacts how big or large the reverse mortgage could be. The lower the interest rate, the more access. Just like on the other side, the lower the interest rate, you qualify for a higher loan. Here, the lower the interest rate, the more reverse equity we can give you in terms of the line of credit. And it is the size of the reverse mortgage is the lesser of your home value or the HECM loan limit of 1,209,750. So what we're saying there is we base the reverse mortgage limit off of a current appraisal. But let's say you own, and I've had this question with financial planners, you owe a $2 million property. And you still now want, I had one financial planner call me and say, I have a client who owns a $3.2 million property, and he's self-employed and he's tired, and he owes about 900,000 on his, on his loan. Can he do a reverse and eliminate those payments and use that differently? And I said, absolutely, we can go to 1,209,750 in terms of maximum loan amount. Now, if you think about this, FHA loans across the country have various loan limits. right? They're all different. And there are areas of the country that are not high balance areas like Northern Virginia, right? This is the high balance loan limit. FHA reverse mortgages do not have various limits. It is the high balance limit is the limit on this product across the country.
So
So again,
Kelly,
yeah,
I'm sorry. So does it matter how long you've owned the home, or is it just the equity in the home?
just the equity in the home.
Okay.
Yep. So just kind of keep that in mind. You have a lot of high-end borrowers in this area, and the property taxes are high, and they're approaching retirement, and they're trying just to have cash flow per month as opposed to liquidating retirement funds to pay for their mortgage payments. They might say, I have one client that had, like, I want to say $160,000 loan balance on a home in McLean that was valued at like 1.75. That's a really easy fix if they want to stay in that home and use a reverse mortgage to meet the property tax bills and all of the maintenance requirements for that property without selling it. Right? So, and not depleting any retirement funds. Or for some people, their home is their retirement account. But if they can't access that equity, what good is it to them if they want to age in place, right? So there's a lot you can look at here. It's not just for that tiny little scenario, it's for high wealth or high value properties as well as an alternative to liquidating other assets that could continue to grow over here for you at a faster rate than what you're paying over here. All right. So to give you an example, let's say the youngest borrower in this example is 74 years old. And PLF just means it's a principal limit factor or maximum loan amount factor that we use at selected ages. Let's say, wishful thinking, the expected rate comes down to 5.5%. The value of the home was 600,000. Well, we look at the chart at 74 is the age, 5.5% is the interest rate at this time, and the principal limit factor is 45.8. If we multiply that out, the available loan proceeds would be 274,800. Okay. Now, if the borrower owed 120,000, you would deduct 120,000 from the 274. You would have to deduct the closing costs associated with the reverse, which I'm going to tell you they're higher, and I'll explain why. But figure about 5% for closing costs. Okay. And then what's left would be available on the line of credit that they could access. So how can we use this line, right? So let's just talk about the buckets of wealth, right? You have 3 buckets, right? And when you're working from the age 18 to 62, we have that what's called pre-retirement wallet, right? You've got in bucket 1 your standard wages, commissions, business earnings, pensions, and Social Security. Your fixed income, you're earning the income, right? This is what's coming in each month pretty much on a regular basis, right? You've got bucket 2, which could be 5 to 20% of your what you've saved over the course of your working career for retirement, right? This is your 401ks, your stocks, your mutual funds, any savings. Maybe you've got life insurance policies that have cash values and IRAs. Okay. Then that last bucket, right, which you're not touching in any way, shape, or form other than feeling really good that you have home equity, right? It feels good. It's not working for you, but it feels really good to have it. Is that real estate equity in your home? Okay. So when you looked at this, when you get to age 62, your earned income starts to decrease. You've got your supplemental income, which is fine, right? But you've got no monthly mortgage payments if you swap out a reverse mortgage and extinguish the payments on your current mortgage now. And then that cash flow is freed up. Okay. So you can take your mortgage loan proceeds, depending upon how much you have, in several different ways, right? It can be a lump sum single disbursement. It could be fixed monthly advances. It could be a straight up line of credit. You just set it up. You're not drawing on it unless you need to. You just want it set up and you don't want to have to make payments on it. You want to access money and not have to pay it back. Or you could do a combination of the two. So I always tell this story because in 2006, my father passed away. My mom and my dad owned their home outright. And of course, I come from very, very humble beginnings, and there was only Social Security for my parents in retirement. So, of course, mom's Social Security gets cut way down when dad passed away. And about a year and a half after he passed, we decided to do a reverse mortgage on her home. And she said, you know, I want to get this set up. I want it set up as a stipend each month to help make up the gap of what I lost in Social Security. But if I could get a lump sum as well, I want to put a new roof on the house. I want to put a new roof on the garage. We had a separate garage. And can I do it this way? So in 2008 or 2009, we set up the reverse mortgage, and she received monthly up until last December. We sold her house and she still made profit. So up until last December, 1,300 a month, tax free each month in her bank account on that reverse mortgage, and took out like 35,000 at the time to do her roof on the two structures back then. So, she had that loan for almost 17 years and still walked away with profit when she sold the house. Now she's going to be 94 this year. She is in great shape. She happens to be living with my sister now because she just didn't want to take care of the home anymore. And she's still able to do everything herself, still drive, still take care of herself. She's in great shape. But now she has some money in the bank and she doesn't have all of the expenses associated with the upkeep of that home. Okay, so there's a lot of flexibility here in how you can use it. So the unused portion of the line of credit grows, and it grows at the same compounding rate as the loan balance grows. And the great thing about a reverse mortgage is they think old school in this regard only. You will get mailed a statement every month, and it will absolutely tell you how much you owe and how much you can access every single month. So you're never unsure of what you have left, what you could do, or how that limit is growing over time. Okay. You will have greater borrowing capacity over time. So in a hypothetical example, let's say you take out $100,000 in a reverse mortgage in year one, and the balance at the end of year two is 110, let's say. Well, you're a commission realtor. You don't know how much you're going to make each year, maybe until you get to like September or November. You might say, I don't want to pay anything toward this reverse mortgage if I don't have to. But in my head, if I'm having a really good year and I want to kind of keep the loan balance a little lower, maybe I'll pay $10,000 against the principal on this reverse mortgage. Okay. Well, if the line had grown to 110, you started at 100. If the line had grown to 110 and you pay 10 back, you still have access up to that 110. It never gets capped, frozen, or eliminated due to market conditions. So whereas the big banks in 2008, 2006 to 2008 said, guess what? We have deflating values on homes, and your equity line that you took out for 100,000 is now capped at 50 because home values have declined. That cannot happen on this loan. Okay. Can't be eliminated. You know, other big banks said, hey, we're not in the equity line business anymore. You have this much time to refinance this or the balance comes due, right? So it's definitely a different program that way. It is liquid home equity, meaning you can borrow it, you can pay it back and borrow it again. Just don't take the balance to zero, because this is a first mortgage, not a line of credit second mortgage. You know, on your line of credit, if you set it up and you have a zero balance, it's still open. You can still access it, right? On this loan, if you pay it off to zero, the account gets closed. Okay, so take it down to $1,000 and leave it there. Just don't close it. All right. So this just lets you know how, for example, if you took a 62-year-old borrower and the value of the home was 600,000, the line of credit we're saying at that moment could be 223,506. If the borrower held this for 27 years, at age 89, we're estimating the value of that home would have appreciated to $1,024,000, but the line of credit would have increased to $1,026,000. So it's growing and growing over time. You can use a HECM to extinguish a forward mortgage with a reverse mortgage, right? You have a current mortgage you have to make payments on now. You want to refinance it to a reverse mortgage where you don't have to make principal and interest payments. You want to extinguish that principal and interest portion. So when you look at your monthly payment, you've got a $3,000 payment, 2,000 of which is principal and interest. The other 1,000 is taxes and insurance. You now are replacing your cash flow by eliminating 2,000 a month, right? You're trying to consider, do I retire? What's my Social Security going to be? How could this work, right? So again, you could use this to enhance cash flow in economic downtimes and not pull from those reserves you set up for retirement. So think about this for a second. You've got $500,000 with your financial planner. You set up a reverse mortgage on your house. Well, I don't know about you, but the stock market's been a roller coaster ride, right? It's been up, it's been down, it's been all over the place. And you're like, I typically pull out this much a month to live on. And it could be the worst time to pull that money out as things start to rebound. You might want to leave that alone, right? And use your reverse mortgage as your monthly stipend for what you need to live on each month instead of taking out a taxable loss, right? You've got taxable gains and you've got losses, right? And there might be strategic times that your financial planner says, hey, look, let's just take the loss on this. You know what I mean? But I want to leave this alone because the gain on it is so much greater. You know, it just gives you the opportunity to have that conversation where you can benefit in investment growth as well as reduce your tax liability for whatever assets you have remaining. You can use it to increase monthly cash flow, close a retirement gap, meaning you're 62, you don't get Medicare, until you're 65, but you want to pay for those insurance premiums for those 3 years. Maybe your reverse mortgage can pay for those premiums. You want to, not start taking Social Security perhaps until you're 65 or 67, whatever it is for your age, right? because you want to get the most you can out of your monthly Social Security. So maybe you use a reverse mortgage to still stick with your initial plan. Because I know when I started working, retirement was 62. Now, as a boomer, full retirement age for me is 67. So that wasn't expected, right? So, do I still retire at 62, or do I and not take Social Security till 67 to get the most out of it? Or do I adjust when I start looking at Social Security based on where my retirement assets are? You can use it to help family, you can make donations, you can, help a kid buy a home. Again, you can use it as a wealth multiplier and pass on a larger nest egg. I get a lot of people that'll say, well, I want to leave this house to my kids. Sometimes your kids don't want the house. They're happy with money, so maybe leveraging the house and having that pocket of money set aside for the children over here that's growing without being touched is better for them, instead of them dealing with having to sell the house that they don't actually want, you know. You can use it to pay for renovations, in-home care, big ticket expenses, or long-term care insurance premiums. Obviously, as you age, that's a big concern. What if you need long-term care and you still want to age in place, but you want to pay these premiums to help offset the cost of what that in-home care might be as you age? And long-term care insurance is very expensive. So here, just to give you an idea, and I've got to update this. This was a few years old, but home health care is about $60,000 annually. For Alzheimer's care, meal prep, diet, light housekeeping errands. Like, we're not talking a lot. Someone's going to be there, right? You have some assisted living facilities, which will be about 54,000 annually. And, private apartments, on-site nursing, help with daily living and medication. You go into private nursing home care, you're over 108. You're going to be higher than that now because these are old stats. But full-time in-facility care, advanced long-term care, therapy, rehab, medication, and skilled 24-hour nursing. So again, is anybody's portfolio prepared for that? Right? We're all hoping we're good, right? That we're not going to need that. But you just don't know. You can also use it to help keep your adjusted income low. So like, as I mentioned, any distributions from the reverse mortgage are not income. You don't pay tax on it. So you could do a combination of distributing from your reverse and distributing less from your taxable investments, so that your bottom line tax burden, maybe you move that to a lower bracket as a result. So you can make your traditional retirement funds last longer. Again, it helps your financial planner with timing, right? Now's not a good time to liquidate that asset. Okay, I'll just pull from the reverse instead for now. When it's a good time to take gains off the table, maybe I'll take some of those gains and apply it to my mortgage at a later point. Again, you can use it against longevity to pay for long-term care, and again, maximize your retirement contributions. So when we talk about how to incorporate this into a retirement income strategy, and again, I would look up Wade Pfau, Pfau. He does a lot of books on this topic. Why would you set this up earlier in your life than later? Okay, so it's not just us saying it. The Sachs and Sachs coordinated strategy. If you open the HECM line of credit early, like at age 62, statistically speaking, you have a 78% cash flow survival rate in retirement. 78%, you're not going to run out of money. We're assuming that you're taking 4% out as your post-tax withdrawal rate, right? That you've got $2 million in retirement, 4% out is $80,000 a year. We're assuming you're pulling 4% out because it's going to grow at least 4% based on a 32-year investment return. When you treat the home equity as a last resort, right? Conventional passive strategy, and you delay opening the line of credit until all of your portfolio is depleted, you now have dropped from 78% down to 60% cash flow survival rate in retirement. Again, assuming that 32-year investment return, right? If you ignore it, okay, you ignore the reverse and all your home equity, you just have paid off your house, it's just sitting there for your heirs to take from you should anything happen to you, or you sell the home, right? You have a cash flow survival rate of 35%. That's assuming you're using all of your portfolio to live on. Okay, so it just gives you some kind of ways to rethink about the air around you in your home and how it could be helping you in retirement. This is just a chart based on what we just talked about. So I'm not going to spend a lot of time on this one. But over here where it says the source, Wade Fowl, the retirement researcher's guide series, reverse mortgages, how to use reverse mortgages to secure your retirement. That would be kind of the books you would want to look at if you want to get more information about strategic uses here. It has the top consumer protections. The borrowers have to be counseled by a HUD counselor. So if we do an interview with a client who's interested in a reverse, I would send them for counseling. They would call a counselor. They do that in person or via Zoom or over the phone. They go over initial disbursement limits. They do a financial assessment when we talk. There are non-borrowing spouse protections. So let's say we have a spouse that is not 62, they can't be on the loan, but they're on the deed. There are protections in place for the spouse to remain in the property should something happen to the borrower. You have a secure line of credit, and that unused line of credit grows over time regardless of the home value. And that non-recourse feature, which again, I'm going to visually explain here. You can definitely use this to buy a home, and as real estate agents, if you are working with seniors and they're talking about selling their home and downsizing to the next property, but they're going to pay cash, why would they do that? They could put 60% down, have a 40% reverse mortgage, keep that 40% of the proceeds working for them in an account with their financial planner and not have a mortgage payment. I mean, why, right? Upsize, downsize, right size into the ideal home. One of the number one reasons people look to do sell the current home and buy another home would be to be nearer to their family or grandchildren. Maybe they just need a one level living. And again, you could put as little as 45 to 65% of the purchase price down from your funds. That's depending on age. The older you are, the lower the down payment. The younger you are, the higher the down payment, because it's all based on actuarial tables. Keep more of the money out of that house you're selling, working for you in your portfolio. Why pay 100% cash? If the goal was just to not have payments, this is the perfect loan for you. And then no monthly principal and interest payments. Again, still have to pay taxes and insurance just like you would on any other property. There are something called proprietary reverse mortgages. These are not FHA loans. These are conventional loans that certain banks create to meet a particular need in the retirement market. They do cater to the older adult communities. Sometimes it's for loans greater than the FHA loan limit, typically $1 million or more in property value. Maybe it's a non-FHA approved condo complex and we can't get it FHA approved. Some proprietary reverse mortgages in certain states have ages at 55 and up versus 62. And there's no mortgage insurance premiums on them because it's not FHA. Okay, but there's just different requirements. So there are some out there, they vary state by state and investor by investor, but there are some solutions out there. So what happens at loan maturity, right? What causes this mortgage to become due and payable? You want to sell your home. Okay, sell your home like any, sorry, come here. Like any other, Gemma, I apologize. Come over here. Come here. You want to sell your home. You want to transfer the title to someone else. Okay. The last surviving borrower moves out of the home permanently. So I'm not talking about the snowbirds, right? Who want to spend, come here. I apologize. Come here. Come here. Go sit. Apologize.
Kelly, all dogs welcome.
I know we work remotely.
We love our doggies.
You want to transfer the title to someone else. The last surviving borrower moves out permanently. As I was saying, it's not snowbirds, right? It's your permanent residence. You want to spend 3 months of the year out of state. That's totally fine. You get injured and you go into a rehab facility. As long as it's not permanent, it's still fine, right? You're coming back to the home. If you default on the loan term, so what does that mean? Because you don't have to make payments. Well, just like on your regular mortgage now, if you stopped making your property tax and insurance payments, they can put a lien against the property, right? The loan could go into foreclosure just like it could on any other house. It doesn't matter that it has a reverse loan on it. You still have to pay your taxes and insurance. So it could be called, right, or move into foreclosure because of those reasons, or the last surviving borrower passes away. So what happens when the heirs are faced with this, right? So how does this loan get paid off? Well, the loan is not yet due and payable. So the borrower can pay as little or as much on the loan balance as they want. They don't have to make payments. They can just make the taxes and insurance payment. When one of those prior maturity events happens, the loan is typically satisfied with the sale of the home. As a non-recourse loan, the sale of the home will always satisfy the loan repayment obligation. The borrower or the heirs will not be personally liable for any balance deficiency. So again, as I mentioned earlier, you sell the home at 400, the balance due is 450, doesn't matter. The heirs are not responsible for that 50K delta. And if I was inheriting that property, right? If I'm the heir and I owe 450 and it's worth 400, I'm signing a deed in lieu. I'm giving it back. I don't want to work to get that on the market for what? Right? I'm not going to clean it out. I'm not going to do anything. I'm going to sign it over to the bank and I'm going to let them deal with it. Because there's no point for the heirs to spend one dime on that if they don't want the house. Okay, now let's talk about if they do want the house, right? So if you look at the grid, do the heirs want to keep the home and is there equity left? In the top left quadrant, they could pay off or refinance the loan balance. Okay, they inherited the house. They're going to refinance it out of the reverse mortgage and keep it. They certainly can do that. If they don't want to keep the home, they could sell it and pocket the profit, just like if it was a forward mortgage, they could pocket the profit. So let's say there's no equity left in the house, but they really want to keep the home in the family, right? The house is underwater, but they can't let grandma's house go to a stranger, right? They could purchase the home with a short payoff of 95% of the appraised value. So again, you owe 450. The house is worth 400. They can buy that house if it appraises at 400 for 380,000. Okay? Keep it in the family. If there's no equity left and they don't want it, they sign the deed in lieu of foreclosure and walk away. And that's it. They're not liable. That's what mortgage insurance is for. Everybody hates that word, FHA, MIP. But that's what this fund is for. And again, the only reason we go into why Fairway is we are one of the top reverse lenders in the country as it pertains to the HECM reverse mortgage. We have an entire department dedicated solely to reverse. So we're really passionate about it. You see a lot of stuff come out about reverse mortgages on TV and elsewhere, but we are in the top 5 in terms of doing reverse mortgages. It's something we really are very passionate about, and it's underserved. You know, we're just trying to get the word out, because the boomer generation, much like the millennial generation, are 2 of the largest generations that we need to pay attention to, right? And people are just living longer. And they need to be smart about their assets. And this is one way that can change maybe their way of thinking about their home. And that was really all I had today. We're right at the top of the hour. Any questions? Anybody have any questions that I could answer for you?
Kelly, I just had a situation, and this is what happened.
Sure.
I have a customer, a client rather, and what she decided, her husband died 2 months ago.
Okay.
She only had one pension and one her social security check,
Mm-hmm.
which is not enough to cover her bills.
Okay.
So what she was not aware of, I don't know, this is really crazy. She said she wasn't aware. Her husband refinanced the home before he died 2 months ago. They only had a year left on the home, and he refinanced it for what they owed originally. So the home is worth, it can be appraised at about 540,000.
Mm-hmm.
He refinanced it for 168,000 for 30 years with
Mm-hmm.
only a year left. Now we can't wake him up and see what kind of craziness was going on in his head. So she went to the bank to try to get some cash, and I'm listening to what you're saying,
Mm-hmm.
and they're saying that she has more debt than she has income, so they
Right.
wouldn't give her credit.
Right.
So is that going to affect? And my suggestion to her, I said, normally I don't because I wasn't that familiar. I'm thinking about reverse mortgages from back in the day, and they
Mm-hmm.
kind of bothered me. But after everything, and she let her children talk her out of putting her home on the market,
Mm.
and the bank is saying you don't have enough income. And then I'm saying, well, it appears to me that your only option here now, I went to get her an investor. She didn't want to do that.
Mm.
So I said, it seemed like your only recourse would be a reverse mortgage. So based on what I'm hearing today, her credit would still need to be, she said she's not delinquent on anything yet. And I told her she's really going to have to make a decision because I'm afraid that she's going to go into foreclosure and nobody's going to be able to help her.
Right. Bear with me 1 second. Do you know what her age is?
She's 72.
Okay, hang on 1 second. I'm gonna try to do something real quick here. Do you know what he did with the money? Did he deposit it?
Who knows? They can't find that out. They can't get into his accounts.
Wow, okay. Because if you only had a year to go, if the original balance was 168, you wonder if he refinanced it, did he take cash out?
That's what we're trying to figure out what he did
Yeah.
with that. And why would he, or why would a bank even go along with something like that when you only have a year left?
Do you know if it was like a line of credit or was it a fixed rate?
What I could see, it appeared to be a 30-year fixed,
Okay.
a conventional mortgage.
Okay, so her age was 74, you said?
Yes.
And the property
No,
value?
72.
72. And what was the property value?
540.
And she's here in Virginia
Correct.
and she owes 168, right?
Correct.
All right. Can you see my screen?
I can.
Okay. So in this calculation, she would have enough to extinguish that 168. Okay. These are all the closing costs. You've got origination fee. The MIP is what's the highest. That's why I said closing costs are high because it's 2% calculated on value of the
Okay.
home. But all of this gets rolled into the new loan. And based on this, she would have about $11,000 left over on the equity line that she could tap into, but it would eliminate whatever the principal and interest payments are on the first mortgage. So like if she has the mortgage statement, look at her payment breakdown, she would not have to make that mortgage payment, right? I don't know if she's making that mortgage payment now or taking it out of savings, but we would be looking at her Social Security and her pension to see if she has enough available to cover her taxes, insurance, and any other monthly debts she currently has. And that
So,
lets her stay in the house.
so what this bank did, they separated, she does not have an escrow.
Okay.
So the taxes and insurance are paid separately herself, and her mortgage is like 1,000 something per month.
Mm-hmm. So she would
So,
save that 1,000 something per month by doing a reverse.
but are you saying that's all she has available that she can draw on is $11,000?
Correct.
Oh my word.
Correct.
Hmm. That's
Without
not,
making payments, right? Because remember, this balance is going to go up over time.
so you can't
Why
do
it's
a
that
fixed
low?
rate? You can't do a fixed rate and keep that there?
No, this is a line of credit. This interest
Oh,
rate
that's
is
a
going to
line of
move up
credit.
and down, right?
Okay.
It's going to move just like a home equity line of credit does now in reverse, like a credit card,
Okay.
right? So the best scenario for her is it extinguishes that $1,000 a month. So then you look at what is she getting fixed monthly, and is that enough for her to live on and make her tax and insurance payments? So that's the question. Keep the house or sell the house. If I keep the house and move it to a reverse, I'm only really saving 1,000 a month. And is that enough for me to continue to live there happily? And if it's not, then maybe selling the house and moving in with one of the kids or something is a better avenue. It's tough. That's a tough situation.
It really is. I mean, I was pulling out the little bit of hair that I have.
Yeah, that's
Mhm.
why I suggest to everybody, you
Mhm.
don't know what people are going to do when they get crazy.
That's
I'm
right.
I
serious.
lived through it and
Mhm.
I have everything in a trust. And the reason I did that was because it's very protective and translucent. And all of you women out there that are not on the mortgage, you make darn sure you get on the deed. and be on the title of that loan if there's still a loan. Okay. You can't rely on people. They may die.
Right.
And then what are you going to do? Nobody will talk to you. But when
Yeah.
you have a trust, the trust owns everything.
Right.
And that is a great byway into having access. I'm like an expert on what happens after your husband dies, except
Right.
I knew way in advance that I needed to know. And by golly, it's a good thing too, because he went nuts.
So
So
I see that Pat has a question, how money grows with reverse mortgage. So the money doesn't grow, the line of credit grows. So if you're looking at my screen, you see this principal limit of 203,580 right there. Okay. So if it's 203,580, and if I did simple interest calculation, meaning you see that I'm just going to say 6.5%. If I took 203,580 times 0.06 and divided it by 12, the interest cost on that loan could be like $1,000, right? A month, let's say. So next month, that balance might be 204,580. So that line of credit's going to keep going up. And you're going to say, well, Kelly, that's the balance on the loan. That's right. It is the balance on the loan. It doesn't mean your access to cash goes up. Your access to cash goes up if you paid some things down, meaning that line continues to grow and grow at the same rate of usage on the reverse mortgage. Right? But your access is only your access.
but doesn't like a line of credit, doesn't the value go up and down depending on the market conditions as
Correct.
well? And whether properties increase in value and
Correct.
that's just like an illusion, or it's a bad thing where it goes down,
Right. So every statement that you get, every HECM statement that you get, it will always tell you the available line of credit you can access. So it'll always give you, here's your new principal limit based on whatever factors of appreciation, and here's what you owe if you were going to pay this off, and here's what you can write checks for. It's going to say it every single month, because every month it gets recalculated based on what is the interest rate at that time. Just like a home equity line of credit, it's not fixed. The rate is not fixed. If the interest rate goes down, you're going to have more access. If it goes up, you're going to have less access.
Now,
So,
in the example that she's giving, is the house in great condition or saleable condition or not?
that's questionable.
Oh, okay, good. Okay, so let's just say it's not. There's another big problem trying to sell it at top dollar. So is she motivated to stay there?
Very much so.
Okay, well then that's probably the answer. And you need to get her to understand that she needs to see Kelly. Kelly's not going to do anything wrong. So I would do that. And you need to email me. Where do you live? Where does she live?
In Alexandria.
Okay. Well, I've got a great attorney up there. Not sure that he does this, but he'll know somebody that does. It's going to cost her some money. The gal that I used for my trust down here is also really good at this kind of advice. I mean, she's not her claim to fame, but she's really good at it. A lot less money than somebody in Alexandria. So, but yeah, just email me and remind me attorneys' names, because, somebody needs to help her. I mean, if they didn't have any kind of estate planning, then she needs to put all this in probate. And that means she's going to be paying taxes on it.
Yeah.
Possibly. And I mean, I don't have to put anything in probate, but that's what happens when people don't know. So anyway,
the other thing with the property you need to be mindful of, it's an FHA appraisal. Okay, so you've had experience with FHA appraisals. Safety and hazard issues are paramount. Condition, peeling paint on the front of the house is going to need to be remediated. Like Think FHA. If there's no railings going down to the basement, there's got to be a safety railing. If the roof is in bad condition, like those issues have to be repaired prior to closing on a reverse. You can't use the reverse to fix the house. In some cases, yeah, in some cases,
I
two
discussed that.
appraisals are required. We never know if two appraisals are going to be required. I have two reverses going on right now. One required two appraisals, and I said, why? Why are two required? They're like, we don't know, Kelly. It goes in through a database and an automated system with reverse at HUD. And if it comes back, it'll say, get us a second appraisal.
Wow.
So 1 to 2 appraisals could be needed. I will tell you from experience, the lesser value is what ultimately ends up being used for the reverse limit calculation. But in terms of condition, like I had one that was a 1940 home up in the Baltimore area. They had peeling paint on the exterior that had to be fixed. We had shingles missing on the roof that had to be fixed. Like we're not escaping a subject to repair appraisal, just so you're aware. If there's anything glaring, they gotta be aware that that's gonna probably need to be taken care of.
So instead of this line of credit, you can't get a fixed monthly advance and have a fixed rate instead of this line of credit?
You could do a fixed rate reverse mortgage, but you're not gonna get what you need to pay off this house.
Oh,
It's lower.
oh, it's lower. Okay.
Yeah, HECM is gonna give you the most money out of a reverse situation because the rate's gonna go up and down on it. I do have a fixed reverse product. It's just you're gonna reduce. She's gonna have to bring money to closing.
Oh, my word.
She's not gonna be able to. She's not. It'll extinguish the first mortgage, but it's not gonna be this high. You're probably gonna be about 40,000 less.
Oh, my word. Oh, okay.
So this is the one I always talk about because it just gets you the most and has the most flexibility.
Yeah.
Okay. Well, thank you so much. I
Of
really
course.
appreciate that.
Of
Thank you.
course. And
Well, thank-
Pat, I know you're saying, does the value of the home go up? Are you asking whether or not the mortgage company assesses and changes the value of the home? They're not doing anything with the value of the home. You know that they're estimating that the house is going to appreciate at roughly a 4% appreciation level in their disclosure calculations. That's really just for the borrower to understand that our goal and why we only lend so much on this is that over a period of time, and in our proposals, we show this, over 20 years, the expected balance you'll owe will be here and the expected value we think will be here. Okay, so we do that in our proposals when we send our proposals out. Here's your age now. Here's the expected value now of the home. Here's what we think it'll be in 20, 30, 40 years from now. You know, so you understand at the time of maturity, there still might be equity left in the house, you know, if you don't make any payments on this. Yep.
Yeah, I think you guys know who your go-to person is now. And she's going to send you the slides in a PDF
Yeah.
so you have her information.
Yep.
I am going to put this once it renders this afternoon through YouTube. I'm going to then put the video, update the reverse mortgage video on her Kelly's instructor page. You get to it by going to cindybishopworldwide.com to upcoming events. On the right, it says meet our instructors. Click on that. You'll see Kelly. And you'll click on that to go to her instructor page.
Sure, and happy to answer any other questions. You'll have all my information, but don't hesitate to reach out. Happy to help.
Thanks, Kelly.
All right, you
you,
all have a good
Kelly.
day. Thank you so much.
Take care.
Bye-bye.
All right, bye-bye now.